Namaste, Sat Sri Akal and Adab. This is your host and host, Mr. Bond, welcoming you back on Mutual Funds for All, No Age Limit. This week, we have a very interesting guest who is a very avid investor both in the equity markets as well as in the mutual fund space. Welcome, Parag. Can I request you to introduce yourself to the audience first, and then we will take up your query.
Thanks, Sunil, for having me. I've been a full-time investor for the last 5 years.
Wow.
Prior to that, I was Chief Operating Officer of an Indo-Belgian joint venture.
Excellent.
Yeah.
So don't ask me too difficult questions because you're an investor and you know the markets extremely well. So I don't know what all can I add to what you have to say. Okay, shoot your query.
So I've been a regular follower of your programs and been watching all episodes regularly. I've never seen anybody give such practical advice with so much simplicity.
Thank you.
So last month you spoke about asset allocation schemes.
Yes.
So I'm very keen to know what are these schemes.
Okay, very good. So, we have taken up different queries of different investors, and finally we came up with evolved investors who have been investing for quite some time. So we took up the topic of asset allocation last week and why downside protection is more important. What do asset allocations do? Asset allocation schemes do, because they are manufactured by different AMCs, which are mutual funds. So what they will do is they have a minimum generally of 30% in equity going up to 100% in equity as an allocation. And when do they go to 30%? When the markets are extremely expensive based on the market matrix of PE, PB, dividend yield, momentum analysis, etc. So each AMC will have their own set of these parameters based on which they will do in and out of from debt to equity and equity to debt. They may do it on a daily basis, they may do it on a fortnightly basis, or they may do it on a monthly basis. Also, this reallocation, and that's why they are called dynamic asset allocation schemes. These are the funds which will, based on the valuation, increase equity allocation if the markets are really going towards the cheaper zones, and they will decrease equity allocations when the markets are going from cheaper to more expensive zones. So this is what we call dynamic asset allocation funds, and in the mutual fund context they are known as dynamic equity funds or balanced advantage funds.
Oh, great. So an investor can just invest in these funds and achieve the similar results instead of trying to do
asset allocation on themselves.
Their own. Oh,
yeah,
great.
It's very difficult for investors to do it on their own. So either you have a good advisor who will be able to manage that asset allocation for you, or if not, then these asset allocation schemes will do that job for you.
Brilliant.
Great.
Thanks a lot.
Thank you so much. We'll see you next week. This is your host and host, Mr. Bond, signing off. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.